Welcome to Episode 2 of Module 5, Building a Team, Employees versus Contractors, Legal and Practical Differences. Getting this classification right is critical to building a legally sound workforce from day one. This program is brought to you by the Series of Thoughts team. Misclassifying a worker can trigger significant financial and legal consequences. This video will provide an actionable framework for structuring your workforce, covering IRS rules, practical differences, state-level risks, and paper trail essentials. The IRS uses the common law rules, or the three-factor test, to determine worker classification. What matters is the nature of the working relationship, not what you call the worker. The three categories of evidence are behavioral, financial, and type of relationship. Factor 1 is behavioral control. Do you control how the work is done? A contractor signal is telling them what you need delivered, and they decide how. An employee signal is providing training or setting a daily schedule. A common mistake is using internal tools like Slack with contractors, which signals behavioral control. Factor 2 is financial control. Does the worker have an independent business relationship? A contractor sets their own rates and is not on your payroll. An employee is paid a regular salary and works primarily or exclusively for your company. Be careful not to pay a contractor a consistent monthly retainer that looks like a salary. Factor 3 is type of relationship, examining your contracts and actual behavior. This covers the written contract, benefits, permanency, and business integration. No single factor is decisive. The IRS weighs all evidence together. However, more factors pointing toward employment increase your legal exposure. Walk every new working relationship through these three factors. If you answer yes to controlling behavior, finances, or relationship permanence, you likely have an employee, not a contractor. Understanding the practical day-to-day boundaries is just as important as passing the IRS test. Founders often inadvertently cross the line through routine management habits. Things you can do include defining deliverables, setting project deadlines, negotiating rates through mutual agreement, and reviewing the quality of work against agreed specifications. Things you cannot do without creating employee risk include requiring set hours, demanding exclusivity without clear justification, dictating methods, or providing equipment such as a company laptop. Contractors are a powerful tool when used strategically. They provide early-stage startups access to specialized expertise without the overhead, commitment, and compliance burden of full employment. Ideal use cases include specialized, short-term skills, such as hiring a security auditor, or a project with a defined scope, like a website redesign. The worker should set their own methods and bring their own tools and professional judgment. Some roles require direct employment. When work is ongoing, integrated into your core operations, or requires consistent customer interaction, the law will treat that person as an employee, regardless of your contract. Roles that must be employees include those involving full-time, ongoing work on core business functions. If you control how and when work gets done, you have an employee. Customer-facing roles requiring consistent presence, like sales or support, also belong on payroll. Use this practical flowchart before every new engagement. If any of the questions point to an employee, do not structure it as a contractor relationship. The legal risk is not worth the short-term cost savings. Federal IRS rules set the baseline, but states can impose stricter standards. California's AB 5 is the most aggressive state law when it comes to worker classification. AB 5 replaced the flexible IRS test with the much stricter ABC test. To classify a worker as a contractor in California, you must prove all three conditions are met. These are freedom from control, outside the usual course of business, and engaged in an independent trade. Factor B, outside usual course of business, is the core difficulty for startups. If the work is central to your business, the worker is likely an employee. Misclassification can lead to back payroll taxes, private lawsuits, and heavy state penalties. Beyond California, other states have elevated classification risk. Massachusetts uses the ABC test aggressively. New Jersey uses it for wage and hour purposes. New York uses an economic reality test, and Illinois strengthened penalties for willful misclassification. Hiring international contractors allows access to global talent and reduced costs. However, this introduces new legal complexity, as employment law, tax treaties, and currency regulations vary dramatically by country. You don't need to incorporate internationally to hire legally. Global HR platforms like Deal, Remote, and Rippling Global provide locally compliant contractor agreements and employer of record services. Watch out for permanent establishment risk, where a contractor inadvertently creates a taxable presence for your company abroad. Also, be aware of local reclassification laws in countries like France and Brazil, and ensure IP ownership is secured through country-specific language. Professional employer organizations, or PEOs, offer a middle path between contractor and direct employee. They handle the HR, payroll, and benefits infrastructure through a co-employment model. In a PEO arrangement, the PEO is the employer of record for tax purposes, handling W-2s and compliance. Your company retains full control over the employee's work and management. A PEO is highly advantageous for multi-state workforces by simplifying state registrations. They also provide access to better pooled health benefits and allow early-stage startups to scale quickly with built-in compliance. Leading PEO providers include Gusto, excellent for smaller startups; JustWorks, known for strong benefits; TriNet, suited for scaling companies with industry-specific needs; and Rippling, which integrates IT management. The final critical step is building a complete paper trail. The right documents protect you in audits, disputes, and during fundraising due diligence. For contractors, collect a W-9 before payment and issue a 1099 NEC if you pay $600 or more. For employees, collect a W-4 and issue a W-2 at year-end. These tax forms are non-negotiable. Every contractor engagement requires a robust agreement. Essential clauses include a defined scope of work, clear compensation terms, an explicit statement of independent contractor status, confidentiality, and termination terms. The single most important clause is the IP assignment. Without it, contractors legally own the work they create, which can block funding. The clause must assign all IP rights to your company, including patents and copyrights. Let's put this all together into a complete paper trail checklist. Before work begins, ensure you have a signed contractor agreement, IP assignment, NDA, W-9, and a documented scope of work. During the engagement, save all invoices, record payments with the contractor's name and date, track payments against the $600 threshold, and accept all deliverables in writing. For year-end tax filing, file a 1099 NEC for all contractors paid $600 or more. Send copies to contractors by January 31st, submit filings to the IRS, and retain all records for a minimum of 4 years. We have covered the 4 pillars of compliant workforce classification: legal classification, the decision framework, state risk, and the paper trail you need to build. The 4 main principles to remember are: always build your paper trail, know your state rules, apply the 3-factor test, and understand that classification has major consequences. Getting classification wrong can cost you 100% of back taxes owed, plus typical penalties of $50,000 or more. The IRS look-back period is 3 years, but state laws, like California's AB 5, are even stricter. This quick reference chart summarizes the side-by-side differences between independent contractors and employees across key dimensions, from tax forms to IP ownership. Next up is Episode 3, Equity and Compensation. We will cover how to structure stock options, the difference between ISOs and NSOs, and how to create offer letters that attract top talent. To recap, in this video we covered the IRS 3-factor test, day-to-day contractor rules, state risk like California's AB 5, international contractor compliance, PEOs, and the complete paper trail checklist.